Are you ready to make the most of your oil and gas mineral rights? Welcome to the Mineral Rights Podcast. Get the knowledge and resources you need to manage your minerals and royalties. Here is your host, Matt Sands.
Hello and welcome to the Mineral Rights Podcast. I'm your host, Matt Sands, and I'm here to help you make the most of your mineral rights and royalties. And today we're going to talk about mineral rights news for July of 2023. Joining me, as always, as my co-host, Justin Williams. Justin, how are you doing this morning?
Doing pretty good, Matt. Enjoying the summertime, which it's been hot and humid here.
Yeah, we were complaining a couple episodes ago about it being really cold and rainy in Colorado. Now it's hot and it's starting to dry out. So back to more normal weather for this time of year. Hope everybody's having a great summer, a great July 4th. And we have a pretty slow news month, to be honest, for July. But that said, the few articles that are out there are pretty interesting, Justin, in terms of oil prices, what the activity level in the industry is doing, and how oil and gas companies are responding to current prices. So a lot to talk about there. So do you want to just go ahead and dive into the first article?
Let's do it. So our first one here is an interesting take. So the IEA has been talking about reaching a net zero by 2050, and they've had a roadmap. The article here kind of dives into that roadmap and looks at if the assumptions are unrealistic, could it result in energy cost, be trouble to the economy? And Matt, it really goes into some interesting detail with a almost 100-page report.
Yeah, we'll link to the report in case you maybe have a trouble falling asleep at night and want to read the full report. It goes through all the different rebuttals, I guess, or analysis of what the IEA said in their net zero by 2050 roadmap, which, according to this report, which is from the Energy Policy Research Foundation, they say that the IEA's report has unrealistic assumptions, which could lead to increased energy costs that would hurt Western economies and heighten human suffering. And, whether or not you agree with some of the specifics, I do think they bring up some good points, Justin.
Yeah, I agree, Matt. And one of the points kind of made in here is the ESG focused investment managers, advocating for this net zero policy. It could put them in a predicament. It could potentially contribute to economic instability, and then with their fiduciary obligations, that creates a really interesting moral dilemma for those ESG fund managers. And I think this not the first time that we've talked about this, but this report really kind of gives some numbers on how that could come to fruition.
Yeah, that's a good point. I think the ESG mandate and focused on, reducing fossil fuel consumption from a fiduciary point of view, I totally agree with this statement that generally that's underperformed the market, those ESG funds. And so to the extent that they're needing to do right by their investors, they could actually be, just by virtue of their investment thesis, failing in that duty. That said, that's kind of a minor part of this report. I think the bigger picture, it talks about the IEA's plan, which is really focused on and dominated by renewable energy sources like wind and solar. The Energy Policy Research Foundation criticizes that, saying that it will lead to higher energy prices and a decrease in economic productivity just because of we have increased capital, labor, and land inputs that are required for sort of suboptimal return in terms of the energy production and the cost of that energy production. Honestly, didn't read through the entire report, skimmed through it and kind of took the highlights. But if you look at Germany as a really good case study there, and they've followed that path that the IEA is outlining, and it's been disastrous for them. They've had a significant hit to industry there because of lower reliability of their electrical grid and extremely high increases in prices, again, because the higher cost associated with those renewables and the less reliability associated with those as compared to nuclear, which actually prior to that mandate and kind of going all in on wind and solar, Germany had a significant amount of nuclear energy. And so it was actually one of the better spots, I think, in Europe and has kind of fallen since then, since they've switched away from that. So interesting that the IEA is suggesting that that's the path forward.
Yep, you said it, Matt. And, again, it'll be interesting to see what kind of economic changes or that can make to us. And also, I think it's going to really come down to technology. And this is something we were talking about before the show, Matt. We're just waiting for that next revolutionary piece of technology to really make this path look a lot more realistic.
Yeah, I think that's a key point of one of the conclusions. And a couple of other conclusions that this report, made was that basically there's no evidence that the world is experiencing falling demand for hydrocarbons. In fact, from things that we've seen in other reports and articles that we've reported on, actually the opposite is what we're seeing. Even if you look at what the industry is thinking, you look at BP and Shell in their recent scenarios where they look at different potential outcomes and what the energy mix and energy transition might look like. And we talk about that in more detail in episode 171, where we say, how long will the energy transition take? And we do a deep dive into those two scenario reports. And, it talks about best case scenario, net zero, how much oil and gas we'll use, and then, kind of status quo. And there's a range in there. And in every scenario, pretty much, we still are seeing increased demand for fossil fuels in the near term. So I think that's a really important point to make. And then the other bit that this report says is that the switch to a near all renewable electrical grid will have energy prices soaring more than threefold. So that is, if you think about inflation, you think it's bad now, just wait until energy, which every industry requires, as an input. If everything is costing three times more, then we're going to be in a hyperinflationary environment. So that will have significant impact on the economies of the West. And the other side of that is that we have economic development occurring in these other countries that are just trying to get up that curve and trying to, frankly, just lay electrical lines for the first time and just have some electricity, regardless of where it's coming from. And so, the punchline of this report is that if this model fails to meet the energy requirements for economic development, both in the West and in developing countries, then we're still going to see reliance on low cost and reliable forms of energy, which they mentioned fossil fuels and nuclear. And it seems like it's really interesting. The IEA isn't really keying in on nuclear as the path forward if they're really concerned about low carbon energy, but then also wanting to make sure we have more reliability and cost, being relatively stable. To me, that would seem like the better path forward, but it doesn't seem like it gets a lot of ink in this report.
You said it, Matt. It's interesting that we really haven't looked at that option.
So do you want to switch gears and talk about the next article?
Let's do it. So, oil prices edge lower on interest rate worries. The article goes on to say here that oil prices slipped on Tuesday on signals that the European Central Bank's not done with interest rate hikes, while investors awaited data that could shed light on U.S. fuel consumption during the peak summer driving season. So, Brent crude futures were down 43 cents or 0.6% at 73.75 a barrel. U.S. West Texas Intermediate futures fell 41 cents or 0.6% to 68.96. Both benchmarks had early retreated by more than $1. And Matt is, coming from several different sides, but this was kind of to be expected. And we knew that this was a conversation that we knew that this is an outcome that interest rate hikes could have.
I think you're right. I think we're still seeing hawkish rhetoric from the central banks. Yeah, I think there was an interview with Jerome Powell this week on CNBC, and he said that they're still looking at a couple of rate hikes. They may spread them out a little bit more, but they're not done. And I think to the extent that that is still in the future, we're going to see a lot of uncertainty in the markets, and that's going to continue to put some downward pressure on oil prices. I think we're still seeing oil rebound. Last time it hit below $67 a barrel or so, then it rebounded back up to like $70+ a barrel. So I think we're going to be in that range of maybe $65 to $75 a barrel. And when we talk about the next article, we'll talk about what the market is thinking and what the industry is thinking about that as well. But, I think it's really quite telling that we have these depressed oil prices and, all the geopolitical stuff going on. We had a attempted potential coup in Russia with the Wagner group, threatening to go and attack Moscow and then turning around, and some nonsense going on there for sure. I'm sure there's more to the story than meets the eye, but either way, the markets are still trading pretty sideways just based on the uncertainty geopolitically, and then also with the inflation still not looking like it's done. So
You nailed it, Matt. And the next article here, as you mentioned, so the title is the U.S. shale oil and gas producers pull back after commodity price drop. The article goes on to talk about the prolific U.S. shale industry is decelerating in the face of weakening of commodity prices, suggesting production growth will stall at a time of booming demand. And Matt, this just seems to be kind of par for the course if we're talking about interest rates, the price going down. It's just kind of to be expected that these companies are going to be less willing to go out and put those expenditures forward to drill new wells.
Yeah, I think it is not surprising. I think we're sort of seeing that in the rig count, like we've been talking about the past few months. And so, not a big surprise there. Justin, do you want to talk about that Federal Reserve Bank of Dallas survey that they did of oil and gas industry executives and sort of what the consensus is?
So the survey here is oil and gas activity flat. Cost increases continue, but with moderate. Activity in the oil and gas sector was unchanged in the second quarter of 2023, according to oil and gas executives responding to the Dallas Federal Energy Survey. The Business Activity Index, the survey's broadest measure of conditions facing energy firms, edged down to 0 in the second quarter from 2.1 in the first. So oil and gas production increased at a slower pace compared with the prior quarter, according to executives at the E&P firms. The oil production index was 8.0 in the second quarter versus 10.5 in the first. Meanwhile, the natural gas production index inclined to 2.1 from 7.4. So Matt, there's some interesting changes here from what we were seeing from the previous time.
Yeah, the interesting takeaway here is we saw a very small amount of growth in the first quarter. What this 0 rating in the second quarter means is basically activity level was held flat from quarter to quarter. So, sort of from the first part of this year to the second part of this year so far, we saw activity just sort of hold flat. And I think that's pretty expected when you think about what oil prices have done since then. Oil prices have remained pretty flat as well. So I think until we see something significantly different, we're going to see that remaining flat. I would not be surprised, though, if we see that measure ticking down to slightly negative for the third quarter, just again, based on the leading indicator of what we're seeing in terms of the rig count, which we'll get to here in the end. So definitely stay tuned for that, and we'll dive into the details there. Interesting, though, I think the highlight of this Fed survey, Justin, is the respondents expect a WTI oil price of $77 per barrel by the end of this year. The responses range from $60 to $100 a barrel, which is a pretty wide range. Survey participants expect a Henry Hub natural gas price of $2.97 at year end. So, for reference, it said that the WTI spot prices were around 69.89 per barrel during the survey collection period, and Henry Hub was around $2 during that time period. So I think the moral of the story is they want to see oil prices creep back up above 70 and a slight recovery in gas prices, but they still expect it to remain below 3, which I think is probably right. That's what we're seeing kind of everywhere, is that gas is going to remain depressed. We're kind of in a little bit of an oversupply situation, and while we're waiting on new LNG export capacity to come online, and then oil demand is a little bit stronger right now, and so we're seeing expected increase in that. So interesting takeaway from that Fed survey.
Yep, absolutely, Matt. You sign up.
And the last article here talks about Eddy County. So despite what we just talked about, Eddy County oil and gas tax collections could exceed $100 million by the end of 2023 fiscal year, according to the Eddy County Finance Department. And they said, we're going to break $100 million for the first time, said Eddy County manager Roberta Gonzalez during the June 21st Eddy County Board of County Commissioners meeting in Carlsbad. And Gonzalez said oil and tax collections and property revenues are the main funding sources for Eddy County government. So I think the key takeaway here, Justin, so we hear this sort of bearish discussion around prices, but then Eddy County is seeing record tax collections. And I think the takeaway there is we're seeing more activity in Eddy County than we had seen, kind of during the pandemic or pre-pandemic. So as we saw, a lot of companies sort of shy away from areas where there was federal acreage just because of what was going on in Washington, D.C.
You nailed it, Matt. And we've talked about how the oil and gas companies are kind of shifting to more proven reserves. If they're going to be putting this money in, they really want to be doing it in a place where it's well proven, you have the infrastructure, and they can withstand those lower prices if that's what's to come.
That's a key point. that Justin just made. So I think that is true. And if you think about areas that have that really great economic return, I think the Northern Delaware Basin certainly fits the picture where Eddy County is located. So I think that is good to see increased activity in that part of the world since the companies are kind of back to more normal footing in terms of investing in drilling new wells in that area. We see some loosening of leasing, from a federal standpoint and issuing permits and so forth. So I think we'll continue to see that. It's good for Eddy County. And I think that the moral of the story here is where you see increases or decreases in oil and gas activity, there is going to be a financial impact to the counties where that activity is occurring because, a significant amount of revenue in a lot of these areas, especially in New Mexico, comes from oil and gas. So
You said about, and it creates an interesting opportunity for legislators too to kind of create funnels for that money to give back to school systems like Texas does or other avenues. But that money's got to be there to really create the issue for them to legislate on.
yeah, that's a great point. I think that is some opportunity that more legislators should key in on and look if they want to pass some of these different initiatives they want to do. I think that they're going to need to have oil and gas there and active in order to fund a lot of that. And certainly New Mexico is a big area where the majority of the state resources comes from oil and gas taxes.
All right, Matt, rig count. So really interesting. If we look at a year ago, we're down 73 units from a year ago, which is a pretty significant number there.
Yeah, a year ago we were at 734 land rigs. This week we are at 661. So a drop of just right at 10%, which is, not a huge drop, but it is been trickling down kind of week over week. Last week was 665 rigs. We lost 4 additional rigs in the past week. This downward trend seems to be continuing, Justin.
You said it, Matt, and it looks like, where these units are coming from are kind of spread out. But in the Permian Basin, we're down 1 unit. Haynesville, we're down 1 unit. And Williston, we're down 1 unit. So interesting to see kind of the changes that are going on here and consolidation that's happening.
Yeah, really interesting to see Pennsylvania gained a rig. Everywhere else was negative. And I'm surprised. This is really one of the first rig reports we've seen Texas fall, honestly, since it's been pretty steady or slightly gaining pretty much week over week. So they're starting to trend downward as well. Maybe not as significantly as some of the other areas, but certainly seeing a continued decrease in states that have primarily gas production, with the exception of Pennsylvania, which again, I was kind of surprised to see them tick up by 1 rig. Louisiana was down 3 rigs. You had New Mexico up 2, kind of back to that Eddy County story that we mentioned and the increase in tax revenue there. So that is a leading indicator that 2 additional rigs that should continue to remain robust through this year in terms of production and new wells getting drilled, at least. Whether or not they get completed right away, that's another story. So from a drilling standpoint, Justin, I think the takeaway here is slightly down, but not a big change. And I would expect we'll see this trend continue as prices remain sort of in the $60 range or maybe low 70s.
Absolutely, Matt. And with the worries of demand going down, there's really no reason for them to be thinking that might take a major swing. So it'd be interesting to see if the geopolitical stage changes and we're planning for more demand and if that has an impact on the rig count here.
Yeah, I think one thing that could change is if we get indication that the central banks are done raising rates. That'll help boost the economy, and that should trickle down into the oil and gas industry. And we'll see an increase in commodity prices. And then it'll take some time, but then if we see that sort of stabilize at a little bit higher prices, then maybe by the end of the year, if we're trading in the $77 range, we'll see these rig counts flatten out and maybe tick back up slightly. But when we think about some of the presentations we saw at the Rocky Mountain Narrow Convention last week here in Denver, we had a great presentation by Enverus, and what they indicated was a lot of these basins are in the state of building up inventory again in terms of their drilled and uncompleted wells, or DUC count. And so even though we have these certain number of rigs running and wells getting drilled in these basins that we talked about, it doesn't mean that those wells are necessarily going to get completed right away. And in fact, I was surprised to see some of the timelines that some of these basins see. And, sometimes it's more than a year that a well can sit before it gets completed and before you start to receive royalties. And so that's something to keep in mind, is if you do have a rig drilling a well on your property, be in contact with the operator, ask the question of when they expect to complete the well. You may find that they are not going to complete it until 2024. So something to keep in mind is they're kind of trying to rebuild that duck count. And again, kind of waiting a little bit for prices to recover, thinking that maybe in 2024 we'll see higher prices. And then that way, when they turn those wells on, the return will be better. So interesting to see what happens, though.
Yeah, very interesting, Matt.
All right, well, that wraps up this month's news episode. Thanks again for listening. If you come across any articles you'd like us to cover, you can send that to feedback@mineralrightspodcast.com. And as always, we'll provide links to these articles and the reports we talked about in this episode in the show notes, which is at mineralrightspodcast.com as well. Thanks again, Justin.
Thanks, Matt.
Thanks so much for listening to the Mineral Rights Podcast with your host, Matt Sands. Don't forget to subscribe and share at mineralrightspodcast.com. The Mineral Rights Podcast should not be construed as investment, legal, or tax advice. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy.